How's it going, guys? It's Mike from Seattle. Today I have Carly with me, my lender from Caliber Home Loans located in Bothell, Washington. The reason I decided to use her was because people in the real estate investing meetup group that I have, who are from all over the country, are now reaching out to Carly here in Washington because we have found that she not only offers the best customer service, but has extremely competitive rates, and can really help you save some money. A friend of mine literally texted me right before I started this video saying he just closed or just got the final quote with Caliber Home Loans for what the closing is going to cost. And he's from Florida, and he's using Carly all the way here in Washington. Carly, will you introduce yourself real quick?
Yeah, my name's Carly McEachran. I work for Caliber Home Loans. We're located in Bothell, Washington.
Right, right. And so I actually have a whole list of questions. So some of these questions come from Facebook. I'm part of a real estate investing group, Michael Zuber's group, and I posted that I was going to interview you, and a bunch of people had some questions. That, and I came up with some questions myself. Now, I know maybe to the average person watching this, some of these questions will seem a little basic, but I wanted to cover some of the basics for the beginners out there. But we do have some good questions out there, some unique ones that I didn't even understand, so we'll get to those. Carly, real quick, first question for you right now, as the headlines are all saying interest rates are down, all time lows. It's the craziest time ever. The Fed's just slashing things left and right. It's like a busted car in a bad neighborhood. Can you explain to us what interest rates are and why they're important?
Interest rates are important because they impact your monthly payment and the interest you're going to pay over the life of the loan. That's the main thing, main takeaway there is especially if your monthly payment's going to be a big concern, which most people that's a priority for them. So,
Right, so the lower the interest rate, the lower your monthly payment,
true.
and then also the less amount of money you will pay over the long-term life of the loan. If you're buying properties from a cash flow perspective like I do for rentals, I
Right.
want a cheaper monthly payment because that helps my cash flow.
Absolutely.
Or if you're just a normal homeowner, you just don't want to pay as much to the bank in the long run, right?
Exactly. I don't care who you are, you typically want to get the lowest payment possible,
Right,
right?
exactly. Okay, so when the Fed cuts rates, how does that affect mortgages? Like, okay, Fed just cut interest rates to 2%. Does that mean your mortgage interest rates immediately go down, or how does that, trickle through?
Yeah, the Fed cutting interest rates really doesn't impact directly mortgage rates. What impacts mortgage rates is the appetite to buy mortgage-backed securities. Recently, when the Fed has cut interest rates, they've also been buying a bunch of mortgage-backed securities, and so rates are staying lower. But in the past, when the Fed has cut interest rates and aren't in there buying a bunch of mortgage-backed securities, it really hasn't directly impacted rates at all. And so right now, why rates are so low is because they're buying a bunch of mortgage-backed securities, and really it's a supply and demand economy. So the more someone wants to buy something, the higher the price of the mortgage-backed security is going to go, the lower the yield goes, and there's an inverse relationship between those two. So uh, to answer your question, ultimately, the Fed cutting rates does not directly impact mortgage rates, but right now is a different story because they're in there buying a bunch of mortgage-backed securities to keep the economy, the appetite to buy, investors' appetite to buy these high, so that we can keep rates, keep
Yeah.
rates low.
Right, right. Yeah, and I know that's actually a really common misconception that I myself had. It's like, okay, the Fed cut rates. I should probably call my lender and see what they can do for me. And I've sent an email once or twice and been told, well, it doesn't necessarily work exactly like that. But right now, in the midst of all the craziness going on in the world, as you said, with the demand for the mortgage-backed securities going up, that's actually what's bringing the rates down.
Exactly. Yeah. I mean, really, the Fed rate has more to do with like a 1 day term. So these are like investors on the secondary market are lending overnight. And that's how quickly those rates are that term. Whereas we're on like a 30-day, term for these mortgage rates.
Hmm.
So lowering that rate is going to keep investors motivated. At the same time, they're also buying mortgage backed securities, which are keeping rates low. So I mean, there's not a direct correlation to the mortgage rates ultimately, though.
But the good news is for people right now, they can get a screaming rate.
That's exactly true.
I'm sure you guys have been pretty busy lately too, right?
Yeah, yeah, everyone across the board. I mean, it's been great though. You always have a busy season, and then you have the lulls kind of typically in the winter, and you're seeing things start to shift a little bit. There's a little bit more consistency throughout the years, but definitely spring, summer is where things get a lot busier in the market in general, whether you're buying, selling, or refinancing.
Mm,
So, but right now, I mean, given the current economic state, the Fed in there, they've got their hands in the pot a little bit here, buying mortgage-backed securities to keep our economy, rolling
right.
through all of the
Stimulated.
chaos. Yes, exactly.
Right, right. Okay, so about interest rates, I know some people confuse. So what is a point and what does it mean to buy a point?
So a point is a percentage of what your loan amount is, technically. So if you have a $300,000 loan amount, 1 point is going to be $3,000. Um, that doesn't mean there's no like direct reduction in rate. Um, it's not specific to anything. Really, lenders issue rate sheets each day, and that's really what they're telling you what the cost of each of these rates are. And if you want to buy down 1 point, that could be a 0.5% in the rate, or it could be a 1/4%. It really, I mean, it varies from lender to lender in that aspect.
So then what that means is like if you want a half hypothetically, if you want a
Yeah,
0.5% reduction in your overall interest rate, say from 3% to 2.5, you could pay a point, which would be, in your example, $3,000, the 1% of the loan, right?
sure. Yeah.
Okay. So in that example,
And
so when someone says they're buying a point, they're paying 1% to get their rate dropped some amount that they've agreed on.
exactly.
Okay.
Right. And the point, I mean, it doesn't have to be 1 point. It could be 0.237 in points to get your rate reduced or to obtain a lower rate.
Okay. So essentially, really, what it boils down to is you're putting a little more money up front to get a better interest rate, which can improve your cash flow, as we talked about earlier, or
Hmm.
lower the amount that you pay in interest long term.
Exactly.
Okay, perfect. Okay, so this is a question a lot of people have, and it's going to lead into a couple of my next questions.
Okay.
When you're applying for a loan, a lot of people, especially around here in Seattle, where everything is ridiculously expensive, how is your total loan amount figured out? Like, how do you decide that I qualify for a $500,000 loan versus an $800,000 loan?
Hmm. It has to do with your essentially your debt to income.
Okay.
Um, so your there's a debt to income ratio that is has to do with really what your maximum, how much house you can afford, what you can qualify for,
Mhm.
and the tippy top of a debt to income ratio would be about 50%.
Okay.
Um, 45 is probably a better target, especially with constraints from lenders right now due to the pandemic and everything. People higher unemployment rates, etc. So 45 is probably a better target to assume right now. But um, your maximum loan amount that you're going to be able to qualify for has to do with what you make gross monthly compared to what your estimated housing payment is going to be and your minimum monthly debts that you're paying. So if you calculate that, that's going to be your debt to income ratio.
Right, and those minimum monthly debts would be other debt that you have, potentially like student loan debt, medical
Right.
bills, credit card debt, things like that.
So really, yeah, what we're taking are any mortgage payments, your um, student loans, like you're saying, credit card minimum payments,
Hmm.
car minimum payments. Usually, medical bills aren't going to be reported on a mortgage credit report.
Okay, interesting.
If you have, say, child support or alimony, those are also debts that get included in here.
Right.
But things that aren't are like your car payment, your cable
Mm,
bills, those are not calculated. So
mhm.
that's something to consider when, say, you're at a 45% debt to income ratio. Well, that means that really that might be 70% in your actual life.
Right. Right.
So
Exactly.
sometimes people don't want to get qualified for their very maximum just for that. sake alone.
Right. Is there a like a preferred target range you're hitting for? I mean, if 50% seems a bit high, is it like 20%, 30%, 40%? What's the preferred range a lender's looking for?
It really depends on the profile itself. So, like, if, for example, someone has a solid credit history, solid income, like there's not a lot of late payments on their credit report, for example, they say maybe they have quite a bit of money in their 401k or investment accounts, the approval really is not going to have a problem issuing an approval at 45% or 48% DTI, debt to income ratio.
Hmm.
If somebody has a little bit more derogatory credit, don't have a lot of assets besides what they're using to purchase something, then sometimes it's harder to even get an approval if you're at your maximum. So
Right.
it really depends on the profile itself. If you have a history of like having a difficult time making payments on time, you probably shouldn't be pushing the boundaries
Right.
at 45%. You should probably stick closer to 30, 35%. But for us, it's a matter of getting an approval for you. So we don't have necessarily like preferential views on like exactly where you need to be. It's
Right.
just a matter of getting you approved if you qualify for that and you're comfortable with the payment that
Right.
it results in.
Right. Obviously, you guys can't sit there and be like, "Well, are you sure you want to be?"
Yeah,
That starts to sound discriminatory. It's, do you qualify according to the metrics that you have predetermined or
exactly.
not? And if you do qualify, and then it's the home buyer's decision or choice as to whether or not they think they're cutting a little too close to the line.
Sure, yeah.
Okay.
My job's kind of just to walk someone through that and make sure they're educated in it.
Right. Okay, perfect. Okay, so the next question I had was, why are there such huge discrepancies within lenders then? To give a little backstory, when I bought my first property with you guys back in 2018, which is the duplex I live in right now, I went to KeyBank, Chase, Credit Karma, just because they were online and they were like, "Hey, do you want to apply with us?" I'm like, "Sure, why not?" I did this company called Catlin Capital. I think I did one more, and then I applied with you guys, and I was approved for as little as $190,000 total loan amount, and as high, two places you included approved me for 450,000. Where does that huge discrepancy come from? Because that's huge.
Well, I would say first and foremost, the income that you're calculated with. Um, some lenders might miscalculate your income. If you have overtime income, maybe they didn't do enough or get enough documentation. You have to have a 2 year history, and we
Right.
average that.
Hmm.
So you have to have enough information to actually give you credit for that properly.
Okay.
Um, if there's any other income sources coming in, maybe you have a second job that we're able to give you income for. You
Hmm.
have to have a history of working a second job for 2 years to even be able to give you that income. So my best guess, I suppose, would be that they didn't do enough in calculating the income because it really comes down to income and debt, right?
Right.
When we're figuring out our total loan amount here. So somewhere in between those areas, there had to have been some sort of miscalculation.
Okay.
There could be more slight variances between lenders and the maximum loan amount because of like more reasonable miscalculations or just being slightly off with the income calculation. So maybe somebody saying 450 versus 425 or
Right.
something.
And
That
there,
would be a little bit more reasonable, I suppose.
Yeah, and I did get, so like KeyBank, who's the bank I've used since I was 18 years old, and I bought this when I was 28. They've had my bank statements for 10 years and seen what I make. Came in at like 423, I think is what it was.
Mm-hmm.
Maybe it was 413, 423. And of course, you and another lender was 450, and that's pretty close percentage wise. Maybe they're off by less than 10% or something like that.
Sure, yeah.
But yeah, and it would make sense that like the online ones that I went through, like Credit Karma, because I just thought, why not? I think they were the ones who came in at like 193, and though they should have most of my info because they monitor my credit, who knows? But it makes sense because they never requested anything from me like you guys did when you put me through the pre-approval process. You wanted
Mm-hmm.
statements and income and all that stuff, so that actually makes a lot of sense. I've always wondered that though. I was like, I mean, it's a huge
It's alarming.
discrepancy.
It's
Yeah.
alarming, if
Yeah.
anything. Yeah.
Exactly. It sent some red flags off. Okay, so building off that, what do you actually look for during the pre-qualification phase? Like, what documents do you want from individuals?
So I want documents, I think income, assets, credit, or liabilities. So starting with income, I want things that are going to support your income. So if you're a W-2, I need your W-2s and I need pay stubs. If you're self-employed, we want business tax returns, at least 2 years. You have, your asset statements. I need 2 years or 2 months worth of each account that you want to use towards your purchase or securing the purchase. So sometimes that means we also need investment accounts or 401k statements that really you're not pulling from, but really those are providing us with reserves to show
Hmm.
that you have the ability to make additional payments if something were to happen with a tenant. Credit, so like we're going to pull your credit. Well, if we sometimes there's additional questions that come from that. Maybe there was a previous bankruptcy and it shows on our credit report. We're going to need, proof of when that was discharged. If there's a child support listed, I need to show a divorce decree
Right.
and proof of the child support agreement and things of that nature. So really, as you go through an application, a loan application, and you answer these questions, ultimately what the lender's doing is getting all the documentation that supports the information that we've put in the application.
Hmm. Okay. Moving off pre-qualification, here in Seattle, and I did a video about this recently. Houses, we're seeing houses that get 10 offers in it within a couple of days. A buddy of mine lost out on his fourth house that he put an offer on because the house had more than 10 offers and there was nothing he could do. Now, I interviewed a local Seattle real estate agent. His name's Jim Scott. I'll put the link for that video below. He said one of the key things you can do to be competitive, especially when there's multiple offers involved, is you need to get underwriter approval, pre-approval, like get your pre-approval
Mm-hmm.
underwritten as well. Can you explain that process? And does everybody
Yeah,
offer that?
I think at this point, most lenders offer it. I don't like, given the current environment with lenders being so overloaded with refinances right now. I would bet that a lot of people aren't offering it, or they're not throwing it out there, just as an additional step for them, or maybe their underwriters are overwhelmed and it's just an added stressor.
Mm,
But really, what it is you go through your pre-approval process. I've gotten all this documentation from you, and at this point, what I can do is I can submit it to an underwriter, and that is what happens. That's a step that happens when you go into contract, right? So we get all this info and then we submit it to the underwriter for an approval. Um, Really, we're doing that ahead of time without specific property information. And they'll review your information, your income, credit, assets, liabilities, all that fun stuff.
hmm.
And they issue what's called a conditional loan approval.
Okay.
And really, that means this loan is approved based on the terms submitted con- with the condition of receiving an additional pay stub, proof of the deposit, the large deposit into this account,
Hmm.
or things of that nature. So, really, you have the opportunity to get ahead of the game by putting your file and your information in front of an underwriter. And you also get a list of the crazy stuff that they love to ask for
Right.
ahead of anything else. So, um, in our case, when we submit, we call it a TBD, to be determined property wise approval. Once you actually do go into contract and I do submit your file back, it goes to this same underwriter. That's a huge benefit, having them, be familiar with your information already and your documentation for, specific income things and calculations. So
Right.
that's
Right.
a huge benefit. So for us, that allows us to close a file in 21 days at least or sooner. Sometimes it's as short as 10 days. Right now, it's harder to get a 10-day close, but
Mhm.
it's not impossible.
That actually moves me into a good question here. Let me go ahead and pull this up. Part of the Facebook group that I'm a part of, somebody was asking just questions from, and I hope I don't butcher your name, buddy. This is not my fault. I'm going to go with just your first name because I'm not going to try the last name. Viraj, I think that's your first name. He says he asked the question: how do you find a lender that offers a balance of great rates and a quick closing time? Is there anything investors can do to expedite closing times beside having documents in order?
I mean, I would say the underwriting approval is going to be your best bet to get things expedited. Um, if you're in communication with your lending team prior to things and they're not responsive to you or super responsive to you, that kind of goes to show that once you do get into contract and things are on the line, maybe they aren't going to move quite as fast as you need them to. So that could be something that you take as an indicator that maybe like they're not going to be quite as quick as they need them to be.
I noticed, and I'm going to go ahead. I've been wondering where I was going to work this in. So when I had not emailed
Yeah.
you for like almost a year, and then I sent you an email, and it was at like 10 o'clock at night. I think it was on a weekend. I'll find the screenshots and put them in here. I sent you an email at 10 o'clock at night, and then 5 minutes later, I get an email back from you saying, answering whatever question I asked. And I hadn't heard from you in all this time, and I was like, holy smokes, this customer service is ridiculous, which is, of course, what I put into my Facebook group and all that stuff as they were asking me questions about what lender I was using. So yeah, I've noticed the other thing too. So you're part of Bob Winston's team, right? So it's a team of people, right? And I just have worked exclusively with Carly on the last house that I purchased. Um, but something that he did for me when I put the offer on this duplex was he actually made a phone call to,
Hmm.
I'm not sure who he talked to. I think it was either the seller or
Listing agent.
yeah, he talked to somebody who was like, hey,
Yeah.
this is going to work. We're going to get it approved. The house is going to be purchased. There's not going to be any issues. And he put their concerns about a young person who's never purchased a rental property before to bed, right? And so, as you said, the importance of actually communicating, as I've communicated with you, and you are always responsive, and I hear back from you immediately.
Hmm.
If you're not getting that, that should be a red flag that maybe your lender won't go the extra step to actually close the deal on your behalf.
Totally. And that is like great point. We always try to, as long as we know that the offer's been submitted, we
Hmm.
always do try to call the listing agent and give them peace of mind that, hey, we've looked at this, the underwriters looked at this. This is solid. This is, like you have a good buyer here. We are a reputable lender, and you can rely on us. And especially if it's local, a lot of the times we know the listing agent or we've worked with the listing agent, so that can always be a really great benefit too. But ultimately, you want your team to be responsive,
Right.
and you want to feel like they got your back, and that it's just as important to them as it is to you. So
Yeah.
don't be afraid to be, hold that standard, because that's people do care
No,
out
I
there.
agree 100%, and it's kind of tricky, and hopefully I don't offend anybody when I say this. I purchased my last property out of state in the Midwest, and I've done everything exclusively via like emails, phone calls, and maybe an occasional text message. And there's people who respond right away, and there's people who I gotta email them a couple of times and finally call them up, and they're like, and oh yeah, and sometimes I wonder if maybe it's because they're from a generation that isn't as used to emails. Because I've noticed I've talked to some people who they're like, oh, can I just call you? I don't know how to text, which I understand. I'm not judging anybody, and that's fine. If you need to figure out what form of communication works, that's great. But for some people out there, it's
Hmm.
not because there's any lack of skill. It's because they just don't respond promptly, which can be very frustrating and
Yeah,
concerning when you're trying to buy something that expensive.
exactly.
Well, I will thank you for always being prompt with me. All right, enough talking you up. I'm gonna go ahead and move on to another question. Okay, the minimum value question. So a lot of folks have said, "Hey, we understand that there's some good properties in the Midwest that are much cheaper. I mean, you can find things for like 30,000, 50,000, 80,000, which to somebody who lives in Seattle like you and I do in the Seattle area, I mean, that's unheard of. I You couldn't find anything that cheap here if you tried. Um, so is there a minimum mortgage value that you guys will lend on?
There's a minimum loan amount that we will lend on. So 25,000 is the minimum loan amount we can do a loan on. And you have to think, if you're buying an investment property and the minimum down payment is 15%, there's kind of a you have to kind of account for that if you're pushing the minimum loan amount with that down payment.
Right, right. So in other words, realistically, the property would have to cost $29,000 so that the loan amount would be no less than 25,000, something like that, right?
Right. Yeah, right.
Okay, and that's fine because I know a lot of people have the main number that I hear the most is people saying most lenders won't go beneath 50,000. And it sounds like you guys cut that in half and go, we'll actually go all the way down to 25,000.
Yeah.
So that opens up the door for a lot more opportunities.
Hmm.
Okay, explain closing costs. What are they and how do they work?
So closing costs are fees that are associated with a transaction, purchase or refinance transaction, whatever it may be. Um, the lender is only going to have so many of those closing costs that are actually charged by the lender. So that's something to keep in mind, right? So, like the appraisal fee, the lender's charging that. There's going to be a small fee for a credit report and other minimal fees. Sometimes lenders charge an admin fee or an underwriting or processing fee. And those are fees specifically charged by the lender. But there's also fees charged by title and escrow that the lender gets quotes from these different, title and escrow companies, and they're, quoting their fees,
Hmm.
through our estimates. That's the main. Those are the main fees, I suppose. So title, escrow, and then you have like appraisal fees and sometimes processing and underwriting fees.
Right, right. And so, the appraisal fee, really, you guys aren't getting paid, right? The person who's doing the appraising is getting paid. And then the
Yeah, exactly.
inspection, usually you're paying the inspector directly. But,
Hmm.
the title and escrow, I mean, that could vary state to state, just or even city to city,
Yes.
company to company. So if you're sitting here saying to yourself, "Hey, these closing costs seem a little bit high," you can call your lender up and ask them to itemize it out because it may not be the lender. It might just be if you were told you're using this title and escrow company by the seller, your lender doesn't have control over that. They're just telling you what they're asking for in money. Am I
Right.
right about
And,
that?
sometimes, before you go into contract, we don't know who the title and escrow company is.
Right.
And so we could be quoting just a company that's close in proximity to where you're looking.
Hmm.
And their fees can vary slightly, company to company. So um, definitely pay attention to those when you're kind of comparing closing costs between lender to lender. And it's like, don't let that be your deal breaker because at the end of the day, they're going to end up with the same fee there.
Right. My friend Caleb, who's part of my real estate group, who just got his final costs for everything hammered out, he said that he had been estimated a closing cost of $5,700, and the actual cost just came in at 2,000. So congratulations, you, on setting great expectations for him, and him being, as I scroll through these text messages, unbelievably happy with that.
Oh, that's great.
Understandably so.
Yeah,
Um,
right.
I mean, it sounds like you obviously you're going to try to make a reasonable estimate, and sometimes you guys could be low, or sometimes you could be high, but ultimately you're going to do your best to get the best value for your customer. And Caleb here lucked out on this one.
Yeah. And it's called a good faith estimate.
Right,
So
exactly. Yeah, and
for a
honestly,
reason.
as somebody who I used to do quotes and things like that, I never wanted to ever ask somebody for more money later, so I would always try to not do that.
Right.
Okay, so what parts of the process are negotiable, right? A down payment, interest rates, closing costs. Like, where does a savvy, educated buyer come in and say, "Hey, can I change some of these numbers we have, pay more down, you get a better rate?" How does somebody come in and negotiate that, and what is negotiable?
So I would say, so we talked about closing costs and how lenders charge different fees.
Right,
So
right.
um, if they have like an admin fee or a processing or underwriting fee, sometimes they charge a point,
Okay.
like we talked about.
Hmm.
And so pay attention to that. That's always worth talking about, worth asking about. Like, hey, would you be able to waive the underwriting fee or your processing fee for me here? Like,
Hmm.
what can we do? I'm not seeing this on other estimates from other lenders. That would be one of the first things I bring up regarding negotiating closing costs. Like I said, there's not too much wiggle room when it comes to talking about closing costs. For down payment, it really depends. So, like, depending on what your product is, right? So, if you're buying an investment home, there's just a minimum 15% down.
Right.
Most of the time, people are trying to put 20% down to avoid mortgage insurance.
Right. Right. Right.
Um, but that is the minimum there. So, there's really like no wiggle room to lower that.
Okay.
If you're buying an owner occupied or a primary residence, then I mean, we can go as low as 3%. But if you do 3%, your monthly payment is higher, your loan amount will be higher,
Mm.
and then your mortgage insurance is also higher. So if you qualify for 3%, 5%, whatever dollar amount you want in between,
Mm.
for that, if you qualify for that loan amount and subsequent payment, overall payment, then totally, like, that's up to you,
Right. Right.
100%. But besides that, like, if you don't qualify for a lower down payment, that's not necessarily negotiable.
Right. Yeah. You can't just. There's laws, I'm sure, that dictate and govern that type of stuff. You can't just be like,
there,
well, we need to cut that.
there's minimum down payments, and
Right.
you have to qualify for the loan amount and the payment, essentially.
Okay. Okay. So I've heard in different, groups I've been to, meetings I've attended, that some places will only give up to 4 mortgages, and I've heard that some places will not allow any more than 10 mortgages. And at that point, you have to go to non-conforming loans in order to get. So, can you talk about why that is, and what you guys offer, and then how would somebody get around that? What is their options once they've hit their 4 or their 10, whatever the limit is?
So Fannie Mae and Freddie Mac will allow you to finance up to 10 properties. Once you get past 4 or at 4, you have higher credit score and reserve requirements that you
Okay.
have to meet. But ultimately, you can finance up to 10 as long as you qualify. I'm trying to remember your other questions here.
How does an investor work around that? What options do they have to move forward beyond that number 10?
So I was going to say beyond 10, there's also portfolio products, or commercial loans that you could you're getting into that realm. So beyond 10 loans, we offer portfolio products generally at Caliber,
Hmm.
but right now they are turned off due to COVID
Okay.
and
What is
all
a
that fun
portfolio
stuff.
product?
So these are loans that really don't fit inside the Fannie Mae, Freddie Mac, boxes. That these requirements are a little bit different. So say you have 11 property, you want to finance your 11th property
Hmm.
and you have a bunch of reserves to show that you offset. Or you have a ton of income to show from these properties. There's factors that you can show that you kind of offset these requirements here. And these are just kind of off programs that we offer. We're calling portfolio programs.
Hmm.
Um, Essentially, they don't fit in Fannie Mae and Freddie Mac's requirements. They're underwriting boxes here.
So then
Um,
you as the lender can still decide to lend that 11th property, but it can't be backed by Fannie Mae or Freddie Mac. Am I getting that right?
Correct.
Okay.
That's correct.
Okay.
Yeah, it wouldn't be. But if you're trying to kind of get around, there's things you could do in consolidating your property. So say you have one property that has a ton of equity,
Hmm.
you could do a refinance to essentially pay off another mortgage that you have financed and roll it into this house that you already have a ton of equity in.
Okay.
That's a way to start reducing your finance properties and allow yourself to kind of keep going.
So essentially, you could let's say you bought one 10 years ago, and over the
Hmm.
next 10 years, you're buying one property a year. Year 10, that first one's got a decent amount of equity, either via appreciation and just loan payment. So you refinance and pull some money out of some of those properties potentially to pay off one or two of them to get your total mortgages down from 10 to 7 or maybe 5 or something like that. And then that opens you up to then continue purchasing more properties, right?
Exactly.
Okay.
Hmm.
All right. I'm just
Correct.
repeat. Hey, this is as much
Yeah,
a
you
learning
nailed
thing
it.
for me too. Okay.
You nailed it.
Awesome. And that was kind of one of my questions was, can you refinance several properties into one larger loan? Can I just say I got 3 properties here? Can I take out one loan to cover multiple properties?
So the scenario that I was just talking about with equity, we could do it in that sense on a residential level, residential loan level. I think what you're asking would be more of a commercial loan product.
Okay.
I think they offer that. I don't know a ton about commercial lending, but I think that is more of a product for them versus kind of rolling in these loans, like paying off these loans and rolling them into one that has enough equity to do so.
Okay. I get in the mail all the time.
Hmm.
Hey, we think your rate can be lowered by as much as $400 a month. You need to call us. And they'll even on the letter, it will have Caliber Home Loans written somewhere on the letter, written somewhere on the envelope, and I'll pull it open it up, and it's not from you guys. It's from somebody else who's either trying to get me to open their stuff by making it seem like it's you. So I call it spam mail. I'm sure there must be some legitimate company out there that maybe uses this tactic, but can you explain to everybody out there like what the tactic is, what's going on, should you avoid it, is it worth calling them up? Your thoughts?
So I've seen these. We've had clients get them and they were like, send us a picture. What are you seeing? And as soon as you read the fine print,
Hmm.
every time, it says this is from so and so lending out of
Right.
so and so's garage,
Yeah.
basically. So these this information that they're getting, they're pulling from public record information. So your loan information is public record. Essentially, there's parts of that. They know who the lender is. They know what your loan amount is. They know when you close. So they're pulling. Sometimes they'll team up. Like target a Caliber lending in Snohomish County or a Ticor title company in Snohomish County.
Hmm.
And they'll follow those and they'll just, come up with this information. And they are lenders, they're actual lenders, but their loan officers usually work, they're small companies working out of someone's garage, like I said. And what they do on the information they provide you is like the very best rainbows and unicorn terms they could ever provide
Right.
someone.
Right.
So it's like
The teaser rate.
820 credit scores
Yeah.
and like it's just like the best terms they could ever provide. So, you could call them up. They might work. I haven't seen it happen. I've had one of my closest friends get trapped in one of that before she called and I was like, oh gosh, what are you doing?
Hmm.
So it's very bait and switch.
Right. Right.
It
Right.
seems,
Right.
like it's not wrong, the terms that they're offering, like
Mhm.
they could, but really they're not specifying exactly what they're basing this information off of. And that's kind of the problem. And so really they're sending this information out to get people to call them, to open the doors, to start having conversations. And hopefully, they're getting people to
Yeah.
do loans through them by doing that. So
Yeah, if they can just convert 1% of the letters, they're probably. Yeah, I
yeah,
mean,
exactly.
personally, I would be less. I'm always skeptical of anything I get in the mail, but I would be less skeptical if they weren't trying to portray themselves as my actual lender. Right? If it
Right.
was just a letter saying, "Hey, we think we can do better," give us a call to check it out. At least I'm like, okay, it's competition, it's capitalism, it's business. That's how it works. But when they try to position themselves as my lender. Hey, we're your lender. See, we used their letterhead. And then you read through it and you're like, no, you're not. What are you talking about? That to me just doesn't feel right. So I would never want to do business with a company like that.
It's very strange. It's a strange strategy in
Yeah.
general. It's like, I don't know who would right off the bat feel comfortable with that based on the information presented. Like, thank you for reaching out,
Right.
acting like Caliber.
Right. Yeah.
Like, so
Exactly.
strange.
Yeah. Okay. Last question. Okay. In the early 2000s, right, the last major financial recession we had, there was liar loans, there was ninja loans, there was banks and lenders doing very shady, questionable things. Predatory lending happened. My question to you is what are the most common red flags that you still see going on today, other than one we just talked about with the scammy letters? Are there other common red flags, things that lenders are saying or doing that you would tell a potential buyer, avoid this person at all costs?
Things I think relatively have calmed down. And I think that most mortgage loan officers, I say for the most part, like are pretty solid. Like we've weeded out a lot of the really shady people.
Hmm.
Um, the one thing that comes to mind is if a lender is trying to deter somebody from shopping, and maybe they say like you don't want to get a quote with someone else, it'll ding your credit.
Hmm.
but really, like, you have a 30-day window to
Right.
shop without it impacting your credit score. So either they don't know that or they're trying to get you to not shop and educate themselves on what else is out there. I don't know which one's worse,
Mhm.
but I think that's the main thing that comes to mind. I'd say, like, that's kind of a red flag. Why
Mhm.
you do you not know that that doesn't impact my credit, or do you just are you worried you can't compete with anyone else's quotes? You know?
Right, right. Yeah, I mean, and uh, like I said earlier, I compared you guys to five other lenders. I tried to get educated as best as I could, and then I picked off of everything that I knew and went with you guys. So obviously, you welcome the competition and then just roll right over them. And again, my friends Caleb, who just purchased in a state in the Midwest, and he lives, I think, in Florida or something like that, is coming all the way to the West Coast to do work with you guys because so far this is the best that anybody is able to find. I know just based on customer service alone, and again, not to talk too much about myself, the property I bought in the Midwest, I called you and specifically said, I want to use you. And you said, no problem. I can be your person of contact and then we'll work with a local group. And I was like, so long as I can still make sure you're my person of contact, that's what was the most important to me because I
Mm-hmm.
like finding people that won't screw me over and I like the relationship aspect of it.
Yeah.
So it's good to go get quotes from other people. You have a 30-day window where your credit's not going to be dinged. If somebody isn't upfront with you about that, that either means they're inexperienced, which is a red flag, or they're just straight up dishonest, which is a red flag. And in my opinion, I think that's the one that's worse.
Yeah.
And like, hey, everybody's new at some point and doesn't know the answer to a question.
True.
But if you're dishonest, that's the problem you're always going to have.
Yeah.
Carly,
So
I
true.
appreciate you coming on to answer all these questions. Real quick, can you tell everybody how they can find you, how to contact you, your preferred method?
Yeah, you can reach me at my number 425-218-4630. That's my cell. Call, text, whatever. I'm happy to chat and help anyone however I can. I'll rely on you to put my email address down for
Sure.
people just because my last name is
Yeah,
long and confusing for
no
folks.
worries. I'll put your business
But
card. We'll be good.
yeah, please share. I'm happy to help whoever. So thanks for having me on, though. This has been fun.
No problem. Thank you.